What is the most important element of the stock market? The stock. What is a stock? A stock is nothing but of a company. Now, how do you learn about the company? By going through the balance sheet of the company. Now, what the fuck is a balance sheet? Balance sheet is nothing but of a PDF document that shows how the company is performing in numbers. It is just like your ITR returns. Every year you file your income tax returns where it shows your tiers on the PDF, right? How much salary you got, how much tax you paid, income tax, TDS, professional tax, what are your expenses, etc. Have you ever thought about why it is even called a balance sheet? Before I knew this topic, I assumed it was about money balance. Let's say you have 100 rupees. If you spend 90 rupees, the balance is 10 rupees. To document this, they call it a balance sheet. That's what I thought. Sounds good, right? It is partially true, but the real reason is this sheet balances clearly assets versus liabilities. In olden days, we didn't have this much technology, right? There was no Zerodha or not even other investing platforms or not even CS. But there was always one mathematics genius who was eating Vimal Pan Masala, tracking all the finances in one old notebook. This genius tracked everything. How much is the earning, how much is the expenses, how much is losses, loans, profits, etc. This is called bookkeeping. Even today, this system exists. It is called bookkeeping only. Just the format has shifted to PDF. At the end of the financial year, which is March, right? Annual returns are filed. Some companies file a little late. In this sheet, there will be one side assets and on the other side, there will be liabilities. I will explain these terms in simple language so that you can understand with examples. If you still think this topic is interesting, let's get deep into the balance sheet of the company in this analysis. First, let's look at what is DE ratio, which is debt to equity ratio. Equity is the capital owned by the company, basically the percentage of shares owned by the shareholders. On the other hand, debt is the capital borrowed from outside. Debt is largely a long-term debt. Companies also borrow short-term debt, which is less than a year, but we need to calculate the long-term debt to get DE ratio. Let's analyze the actual balance sheet. I have removed the name of the company so that it will not appear like a stock recommendation, just so that Nirmala Amma doesn't come after me. Now, if you look at this balance sheet, shareholders' equity is here and the long-term debt, which is non-current liabilities, is here. If we divide total liabilities by total equity, then we will get this ratio of 2.3. Now, what does it even mean? It means for every $1 of revenue generated in the company has borrowed $2.3 as debt from outside. Now, how do you know what is a good ratio? Well, finance experts say 2:1 and less than that is a good ratio. But if the company has a lot more assets, then it is okay to have more debt. If the company has less assets but a lot more debt, it is always a risky bet. Now, let's look at another important aspect of the balance sheet, which is price to earning ratio. PE ratio. Now, PE ratio is one of the important metrics because it shows if the company is overvalued or undervalued. To get PE ratio, we need to divide the share price by EPS, which is earnings per share. For example, if the company share price is 280 rupees and the EPS is 2.5, then if we divide 280 by 2.5, we will get 112 PE ratio. What does it mean? It means for every rupee this company earns, the market is willing to pay 112 times. Around 20 to 30 is considered to be a fair value. Now, how do you know if this 112 PE ratio is overvalued or undervalued? For this, we need to compare with competitors from the same industry. Let's say the competitors are averaging between 50 and 70. Then this 112 is a bit high on the value. Even crossing 80 will also be very high. It means something is fishy about the company. Unless it is a new company which has a very high potential for growth. Sometimes startups come with a very aggressive growth potential, usually will be valued on the higher side. Now let's address the real tool of the balance sheet, which is consolidated cash flow statement. Cash in a company is not just the king, it is the whole kingdom. Cash flow statement tells you if the company is thriving or just surviving. There are three major activities of cash flow statement in a balance sheet. The first is cash from operating activities. This is the upward cash or revenue from the core business operations. For example, my company is into video production, and I also have this YouTube channel, which is a marketing tool, but also acts as a secondary revenue source, right? Production is the core activity of my business, making videos for companies and raising invoices. They will pay money for the production services. If the company is generating more revenue from operational activities, it means the company is performing well. The second is cash from financing activities. It can be borrowing fresh loans, raising through IPO, foreign direct investment, or even buying back the shares, etc. So these are all cash from financial activities. The last is cash from investment activities. This is basically buying or selling assets. If the company has bought any land, buildings, or machinery, they all fall under company investments. In the balance sheet, we can somehow manipulate the profits, but it is nearly impossible to manipulate the cash flow. I will tell you why. Let's say I raise an invoice of 100 rupees for a video for my client. I can manipulate how much is the profit from this, but this cash flow from another company to mine, which is a cash flow, right, for the services, I cannot manipulate this. That's why cash flow statement is a cheat sheet for every investor. So these are the major elements of the balance sheet. Other elements to keep in mind are studying the founders. If you want to judge a company, always judge the founders. Whether the founder has potential to scale up the company, has the potential to come out of difficult situation, or he's just a bluff, etc. So if you study the person, it is easy to study the company. If you are studying a company, always follow the news to know about the person as well as about the company news. And one thing about people, I will tell you, people never change. No matter how many countries you change, no matter how many wives you change, even if you change your gender from male to female, the core personality never changes. If you somehow study this part of the founders, it is easy to study the decision making. And lastly, I am not an investment advisor. Please do not ask questions like which stocks to buy, which stock will perform, which is a multi-bagger stock, etc. That's why they say investments are subject to market risks. Always invest with risk in mind and awareness about the company. So if you like this video, hit the subscribe button and I will see you in the next video.